This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, I can't believe what Fidelity and Pimco just said. It is outright shocking that they could make such statements. Let's go to Bloomberg, where we picked today's story up with a headline. It's getting a lot harder to chase a stock rally from here on. And this is strange because we've been hearing people say that the bull market is back, that this is just the beginning, that investors need to load up because we're about to see another big 10-year run. And here we're starting to see statements from two of the biggest asset managers that are warning investors that perhaps the bull market isn't starting at all. We look at this, it says equities are disconnecting from worsening economic backdrop, and profit warnings and rising rates are about to deal a blow to soft landing bets. As global equities have decoupled from worsening economic backdrop after rising about 13% in 2023, prompting warnings from some of the world's top money managers. Now, this is very interesting because you think a lot of people believe the stock market leads the economy, and there are times it absolutely certainly does. When we see in recovery, stocks tend to lead the economy. But right now, when we look at the data, and we're going to look at a whole bunch of it throughout the show today, is what you're seeing is investors are buying into the fact in a huge way that the bottom in the economy is already set and it could only go up from here, and they want to front run it in a big way. And this is seen as they're chasing the rally here from this point is a big risky move, these money managers are saying, as growing corporate profit warnings, which we're about to hear from as we get into earnings season, are also driving home the message. Resilience is now sowing the seeds for fragility down the line. This from Andrew McCaffrey, the global chief investment officer at Fidelity. The best flagged recession in history still isn't upon us, but that recession will come when the lagged effects of policies will take hold. And this is something that I really struggle with when I hear it. The lagged effects of policies will eventually take hold. Now, you'll notice he's being somewhat intentionally vague here. Is he referring to the Fed and their unwinding of their balance sheet or raising the federal funds rate? Is he referring to something else? Well, we're not entirely sure what he means. But the notable part here is there's this idea that, well, Fed does something or somebody changes some policies and there's a lag. But the problem is we can never define what that lag period is. It always is changing until the event happens. And then it's like, oh, at this time, it took 10 months instead of 6. That's the problem here. He's saying that something is coming. We just don't know when. And what they're suggesting here is that stocks are completely decoupled from reality. This is showing the all-cap world index in black. See, it's rallying here along with the S&P and the NASDAQ. And what we're seeing is the ISM manufacturing data, which we have some latest news on. We'll get to that in the show in a bit, is saying it's headed lower. And normally what happens when you see an equity rally, as you see here during 2019, and you see, of course, a downward trend in manufacturing, eventually that leads to lower stocks. Now, in this case, it was absolutely due to the pandemic, but you can see here in 2017 and 2018, stocks were rallying as the data slowed, and sure enough, stocks eventually turned around. There's maybe a nasty surprise in store for the stock markets and credit markets in the second half of the year. This from the global chief strategist at HSBC Asset Management. That could stem from a combination of weaker fundamentals set against what is currently expected by market participants, which looks like an incredibly soft landing. Now, of course, this shocks me as well because there's a still belief that we're just going to have a soft landing, to whatever that actually means. You'll notice no one ever bothers to define that, hey, this just means only so many people are going to lose their job. We've not seen any sort of soft landing. You have to go back to roughly about 1994 to find what would at the time look like a soft landing. Since then, we've seen nothing of that effect. And now the problem we have is the entire global manufacturing base is slowing down. We're going to look at the data from today here in a bit, and what that's telling us is that's not what a soft landing looks like. A soft landing is when things kind of slow down and then re-accelerate up. So far, we're seeing absolutely no signs of that actually happening. And here we could kind of look at these lagged effects that perhaps Fidelity was discussing in their note. We see the federal funds rate here against the Wilshire 5000 price index. If you're not familiar with the Wilshire 5000, it's the total U.S. stock market. And very rarely do we actually see the U.S. stock market lead the federal funds rate down. Typically, that actually is the opposite. We see here in the global financial crisis, the Fed was cutting rates ahead of the stock market going down. We see that here back in 2019. The Fed started cutting rates as the market went went up and then head into the pandemic. And now we see the market actually had dropped, kind of thinking the Fed was going to turn. Fed says, no, we're going to keep raising rates. Market headed higher. So again, lagged effects, well, I don't quite see it. But many think the Fed's balance sheet has some factor here. Of course, anyone who does is obviously eliminating any factor of the Fed's balance sheet prior to the global financial crisis, when there was absolutely zero relationship to what the Fed's balance sheet was and the equity markets. But using a little bit of chart crime like many people like to do when they compare these, you can see, wow, there has to be a relationship here, because somehow when the Fed buys bonds through its quantitative easing program, stocks magically go up. Well, except prior to this, and of course during roughly 2017 to 2019, when the Fed unwound its balance sheet, and well, stocks actually just kept going up. And now we're seeing as well, the Fed is unwinding. Everyone says that should be bearish for stocks as they continue to pile into the equity market and take it higher. But perhaps the real lagged effects isn't monetary policy, it's just a slowing global economy. To this, we look for the current new orders at the Philly Fed. This is a fusion index, so it's pretty noisy. You kind of just have to look at the trend. And when you see new orders decline, well, eventually stocks get the picture and head lower. We see that going in the dot-com bubble. We see it going in the global financial crisis. New order demand slowed. The market eventually figured out that, hey, if you don't have new orders here, then you're not making new profits. And of course, stocks eventually come down into that case in a recession. We can see that here around 2015, 2016 as the global economy was slowing before China pulled everyone out. And now we're seeing it happen again, except this time investors say, nah, we're pretty sure that this already is the bottom and we want to get ahead of it. But Pimco says prepare for harder landing for the global economy. But one thing that shouldn't be experiencing a hard landing is your trading account. If you had CTA-Timer Pro, we've been talking about the QQQ. It made the call way back down here at the lows to buy in here. Many people said, whoa, that's too risky. The market's only headed lower, and it rallied up. It pulled back, giving investors another chance. The program said, hey, if you miss this one, buy this one. It's taken off, and now it's telling you, raise your stop losses up, maybe take some profits. We'll show you back here on January 9th. This thing was massively short and started short covering. That was in the report to subscribers. And then on March 15th, on that pullback, the machine started buying again. And then again here on June 30th, we started to see some indication of the fast side of the algorithm starting to sell off, suggesting that either raise your stops or take some profits here, because what this program does, it looks at the machine positioning, it makes a historical adjustment on an overlay and tells you when they're at extreme positions, where the machines are moving. It's $30. Link in the description below. We put out a weekend watch list to help subscribers find the ones that are low and get positioned to buy them. But not to be left out, Pacific Investment Management, their chief investment officer, is preparing for a harder landing. Notably harder landing than the other investors. Doesn't mean maybe a harder soft landing, we should say, as the central bank chiefs prepare to continue raising interest rates, he said. The more tightening that people feel motivated to do, the more uncertainty around these lags. Here we get that lag again that we don't know. The reason he's saying they're uncertain is because nobody knows how long they are. We don't know how long they are until we correlate the fact that maybe raising rates causes a problem later on. And we say, well, it used to be 6 months, and it went to 8, then went back to 5. Now it's a 10. We don't know, and nobody knows because the two are uncorrelated. And the greater risk to more extreme economic outlooks, well, there's certainly more extreme economic outlooks coming. We'll make that case here in today's show. As we go back to the Wilshire 5000, now let's take a look at the yield curve and compare that to the market. What we can see is when the curve is falling, it's usually bullish for equities. It's when that curve starts to steepen, the market reacts and has a negative reaction. We'll show you why that is here in a bit. Here, once again, you see the curve coming down, equities rallying, curve steepen. Next thing you know, with a lag, the market comes off the rails. Here we can see the curve going down even more. That means bullish mode for equities. They still think this is good until that curve turns around. Well, don't be surprised if stocks keep rallying here. He had that when rates have risen in the past, a lag, here we go, 5 or 6 quarters for the impact to be felt have been the norm. He also argued that the market may still be too confident in the quality of central bank decisions and their ability to engineer positive outcomes. Well, considering the central banks have never ever in the history of central banking engineered a quality outcome or any positive outcome. Well, we can't say there's any faith in them there, but you notice he says 5 or 6 quarters of rate hikes. Well, something should go wrong. Well, things don't go wrong until they do. It's not a timing mechanism because really the two aren't that correlated. It all comes back to the banking system. Although Pimco thinks a soft landing is the most likely outcome, we'll say a harder soft landing than some of the other managers for the U.S. economy, he said, of course, they're avoiding areas of the market that would be most vulnerable in a recession. And one thing we can do say that matters here is banks tightening lending standards, and that's really the key to what drives the equity market lower. Here you can see the net percentage of domestic banks tightening commercial industrial loans for firms of all sizes against, of course, the Wilshire 5000. So as you see here, banks tighten lending standards, stocks can still rally because there's still money being injected into the economy. It's still moving through the economy, but as banks tighten, they create less money, and less money means, of course, less growth. You see stocks eventually have that negative reaction. You see that in global financial crisis. The pandemic, we're just going to exclude that because obviously that was a one-off event. But look now, once again, lending standards are tightening, but this time investors are saying, no way, that doesn't matter. The inverted yield curve doesn't matter. The declining economic data doesn't matter because the services sector of the global economy, which we're going to get an update on later this week, is going to turn everything around, and that almost never ever happens. It's usually the manufacturing sector that leads the services sector down, as we'll see in a little bit. The firm owned by Germany's Allianz SE is favoring high-quality government and corporate bonds for now, going against the grain that stocks are where it is to be. It's waiting for the company to it's waiting for company credit ratings to be downgraded, which will prompt forced selling among vehicles as collateralized loan obligations in the coming months and years. That will be the time to snap up bargains, he said. Sure enough, you want to buy low and sell high. He cautioned this cycle might be different to the previous ones. Now, that is an obvious statement because this time we're seeing a globally synchronized downturn, and due to this heavily inverted yield curve, and not only curve in the US, but around the world, we're likely to see not just a banking crisis here in the US, but in other parts of the world, and happening at the same time. Yeah, that would make things very different than the past. Central banks may be less willing to provide support for fear of fueling rising prices. At least at the moment that may be true, but that will change when the banking system crumbles. While the fact that so much risk has been transferred to private markets would slow down the deterioration of credit valuations, but not prevent it, he added. But here we can see the Fed just not willing to stop. They're using talk to get the longer in the higher for longer. This from Zero Hedge. The Federal Reserve is attempting to use the dots, referring to their projections of where they think rates are going, to reduce the size of the pivot expected by the market. Now, keep in mind, there is a lot of government data that we make fun of and say it's lagged. It doesn't really matter that much because it's not accurately counted. If there's one thing that you could say has the least amount of meaning in all of the data things that you could look at, is the Fed dot plot. It's so inaccurate to what they actually do. It's amazing that people even care about it, and they do. But higher for longer has largely been a chimera for central banks in this cycle, Zero Hedge notes, but progress on the longer part for higher is longer, or on the progress on the longer part of higher for longer is lacking, and that's true because here we see the SOFR curve is still inverted by 135 basis points, and this has risen since May, but as the chart shows, it's way below where it was just before the banking mini crisis in March, suggesting, as we've been saying, there's another banking crisis coming. Now let's look at the global economy here. I want to look at the manufacturing data. We just got this today because what this does, it goes back and validates what Fidelity is saying, what Pimco is saying, what these other asset managers are saying. Hey, wait a minute. What happens here is retail chases the market at the top. So we talked about in our show on Sunday, retail's coming in as big buyers, but look what's going on around the world. Let's start out with China, the cakes and manufacturing PMI. Remember, PMI Purchasing Managers Index. This is a survey of purchasing managers. At a number of 50 means unchanged. Above 50, the higher it is, the bigger the group of, the faster it's changing to the upside. It's improving to the downside. It obviously is below 50. Here we can see that the manufacturing sector in China is increasing at a snail's pace now. Very small pace from the prior months, almost barely even noticeable. Let's go around the world. How about we head over to Italy? We see now at recession level areas. Now below 45 is a recession. You start getting near 40, you're at depression level. Here you can see it is contracting at a faster rate at 43.8. How about we move over to France? Contracting at about the same pace as the prior month. How about Germany? Depression era numbers here, rapidly contracting 40.6. How about the broad Eurozone? 43.4, contracting at a faster rate. How about Great Britain? 46.5, contracting at a slightly faster rate than the prior month. Well, nothing but contractions. How about we move to the U.S. just from the S&P Global? 46.3, contracting at a faster rate, now nearly at recession level numbers of 45. How about we go down to the headline, the ISM? They're considered the gold standard. They're not a government report. It's still a survey, contracting at a bit faster rate at 46 than the prior month. But look at this, prices paid, 41.8, contracting at a faster rate, suggesting this inflation story is going away. Look at new orders. It went from 42 to 46, so contracting at a slower rate, but still contracting. Look at this employment. Everyone says the employment sector is going to stay hot. We've been making the case it's not. 48.1, suggesting now there's contraction in the employment, which will eventually show up in the employment reports. We've been saying, look, if the factory sector doesn't turn around, they're going to start laying off. That will be the final nail in the coffin here. Let's look at what they've said in these reports. The health of the U.S. manufacturing sector took a sharp turn for the worse in June, adding concerns over the economy potentially slipping into recession in the second half of this year. That we know is coming for sure. And how about this? Leading the darkening picture was a severe drop in demand for goods. Wait a minute. We just heard that demand was going to be going through the roof. Look, the stock market's going up. What? Demand for goods is down. We knew it because new orders were down. We knew that backlogs were starting to fall. And that all eventually leads to employment dropping, with new orders slumping at a rate among the steepest since the global financial crisis of 2009, suggesting that's exactly what we're about to see. Companies report that customers have become increasingly reticent to spend amid the rising cost of living, higher interest rates, and growing concerns about the economic outlook, and a switch to spending and services. Of course, that switch to spending and services isn't going to last long because they just don't have the money to keep it up. The manufacturing sector, once they start to lay off those higher paying jobs, it's going to have a disastrous effect on the economy. And now we look back to what Fidelity says about these lags of monetary policy, and we say, how could they make such a statement? It's all about banks tightening lending standards and the manufacturing sector, both which are getting worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.